Joining me now, Dan Fitzpatrick. He writes for TheStreet.com and is also the president of Stock Market Mentor. Peter Schiff also with us, president of Euro Pacific Capital and author of Crash Proof, How to Profit from the Coming Economic Collapse. We always need someone to rain on the parade. Peter, all right. It's great to have all of you with us. And Jim, since you're our guest host tonight, let's just introduce you to viewers. You know, we're in a situation where the market's hitting record after record, and it appears to truly believe that everything, bar nothing, is perfect right now.
Well, that's the danger. I mean, so many people, so many investors out there really have sort of cooked in all the good news, and basically they expect a lot of good news, which means that when we do get something bad, whether it's some final sort of feedback from the housing market, or whether job growth starts to actually start looking bad, we're going to actually have a market that's going to tumble simply because there's a lot of froth out there right now.
Dan?
I disagree with that. No, I couldn't disagree more, actually. The investor optimism numbers are actually pretty tame still. Over the last few weeks, it seems like one of the big sound bites that we've been hearing is, where is the retail investor? So I don't see the froth here. What I see is a trend that's just gone on and on and on, and it's really kind of ticking everybody off. But that's what good markets do. Good markets climb a wall of worry, and we got a lot of handholds now.
Peter, you're getting, I can hear you getting excited. You're like chomping at the bit.
What we're experiencing is not the effects of a good market, it's the effects of inflation. You know, inflation is driving prices higher. It's driving, energy prices higher. It's driving food prices higher. It's also driving stock prices higher. But people are not getting wealthier in U.S. stocks. They're simply measuring their wealth in dollars of diminished purchasing power. You know, the Canadian dollar has risen by 10% in the last 10 weeks. That's 1% per week. You can really see what's happening to the value of U.S. stocks when you step back and look at it from another perspective. But I also don't think this rally is going to last, even in nominal terms. People aren't paying attention to what's happening to interest rates. They're going a lot higher. We're not going to stop at 5% on the 10-year bond. We're not going to stop at 5.5%. We won't stop at 6%. And as interest rates get a lot higher, that's going to make it very difficult for our market.
Well, that's really a great argument to make. But my question is, where has that mattered before? I understand from a theoretical standpoint that rising yields are bad for stocks, but that's just not the way. That's not the way the market has traded for years and years.
Well, I'm talking about that being bad for the economy. Remember, our economy is highly leveraged. We're dependent on access to cheap foreign capital. You know, we announced our savings rate today, negative 1.3%. We don't have any domestic savings. We need to convince the rest of the world to loan us money. And they're not going to want to do it at these low rates with a weak dollar.
Peter, but we keep hearing that, there is, not only does China have $1 trillion, but we've got these sovereign wealth funds that these countries around the world, especially the countries that produce commodities, have so much money that they're starting, hundreds of billions of dollars of sovereign wealth funds. That money is sloshing around. It's hard to see how it doesn't come here.
No, they're not going to lend it to us, not for low rates of interest. There's no reason to.
But they are.
No, but they're going to stop. I mean, I've been investing money for my clients around the world for years, and the returns in just about every other country dwarf the returns of the United States. Why would anybody want to invest their money here? It makes no sense.
I'm not nearly as sort of bearish as Peter, but I actually do think
few people are.
There's a real danger here when retail investors start coming into the market. It's usually not the greatest sign that you want to follow them in.
I couldn't agree more with that last point. The retail investors typically is the last person to the party. That's just the way the market works. It always has worked that way. We as individuals learned a really big lesson during the Greenspan bubble in the late 90s that popped in early 2000. We as individuals did. The crowd will not learn. The crowd does the same thing again and again and again. But what our viewers here need to realize is you can see what's coming, but you can't see when. All of these things about the low savings rates and the excess liquidity and these other countries are not going to lend us more money. What you're really talking about is should.
Dan, I know we're going to take a break in a second. I want to leave the last word to you, though, here, because I just want to ask you, how much further, since you're our resident bull, how much further up do we have left?
S&P, I think 1,600's in the bag. I don't think it's going to be in a straight line, but that's a done deal this year.
If that happens, Peter Schiff will be in a body bag.
No,
That's
I won't.
okay.
What do you
That's
mean?
okay,
Are you
Peter.
kidding me? Look.
All right. You know what? We're going to take a break. I know you all aren't going anywhere because Peter brought up a great point, and that was what's going on in the bond market. That the single most important number in all of the markets right now might just be the yield on the 10-year Treasury. Treasuries are down for the fourth week in a row. Yields at a 9.5-month high. It's been 47 months of what John Rokas called a slow and steady tortoise climb higher. We're going to be fighting about the bull-bear bond debate, one of the biggest in all of the world, coming up after this break. So should investors be running away from the bond market? Joining us now, Michael Pentos, Senior Market Strategist for Delta Global Advisors, and our market panel is still there and raring to go. Dan Fitzpatrick, Peter Schiff, still not in a body bag. He's got a few more months until we call it out. All right. Michael, let's begin with you since you are our newest contestant here. You know, we've been talking about it's been 47 months since, what, June or July of 2003, where the 10-year yield has been slowly and steadily climbing higher. At this point, is there any reason to be bullish on bonds?
Well, I believe that it's my contention we've entered a secular bear market in bonds. Historically speaking, the yields are very low. And if you look at the demographic challenges facing this country, we have a real deficit if you don't use a budget where you're borrowing from the future. We have a $1.3 trillion deficit this year, $9 trillion national debt, $59 trillion projected deficit, and my question is, who's going to buy all those bonds? We don't have a savings rate in this country. China is trying to break their peg with our currency. Kuwait dropped their peg with our dollar. So when we have to attract all these bond buyers, where are they going to come from?
Michael, but haven't we been saying that for years, though? I mean, that's the thing. I mean, this has been the truth for a long time. There should have been a run away from the U.S. Debt markets a long time ago.
Right, but
it hasn't happened.
That doesn't mean that there won't be. And, you know, you can look at the evidence of what's happening. You know, it used to be that there was private demand for our dollars. Back in the 1990s, private investors were willing to buy our bonds. They don't buy them anymore. A lot of it is central banks. It's foreign governments. That's because private individuals have already woken up to the con game, and they don't want to lend us money.
Peter,
so
let's pull up that chart again, Peter. I don't know if you'd seen it, but Barron's was talking about it. Cash to burn. Morgan Stanley source, and we're talking about the sovereign wealth funds, Abu Dhabi Investment Authority, Singapore's Government Investment Corp, Norway's pension fund, China's $300 billion fund.
I mean, first of all,
these aren't official reserves. I mean, where else are they going to put this money?
First of all, these countries shouldn't even have these reserves. This is the result of a giant subsidy to the American consumer. If these governments weren't buying all these dollars, our economy would have already collapsed. This is purchasing power.
That is the benefit of globalism.
This is purchasing power that should have belonged to the citizens of those countries. Instead, it's been transferred to Americans. But look, they're not going to lend it to us. And our borrow and consume economy is going to collapse under the weight of rising interest rates. You know, Mike is right. Interest rates are going to keep rising. They're not going to stop. And it's, you know, we're going to 7% on the 10-year, 8%. They're going to keep heading higher. And, you know, you've got all these adjustable rate mortgages out there. You've got a national debt that has a short-term maturity.
What would you buy? You just said that you think bonds are in a bear market, stocks are in a bear market. I can't imagine you like real estate. I mean, if you're going to have that $12 trillion in spending power by 2010 that Morgan Stanley says these countries are going to have, not counting reserves,
look, I mean,
where would you put it?
Look, I mean, Morgan Stanley just announced a takeover 2 days ago of one of my largest positions, a REIT that I own in Australia.
Well, you should be happy about that.
And, you know, I'm going to continue to put my money out of the country exactly where I've been putting it for 8 years, in good income-producing foreign assets, taking advantage of the better returns abroad, the higher dividend yields abroad, and benefiting from rising foreign currencies.
Danny's got a good point there. That was a convincing point.
I thought you just said that yields were going to be rising on our bonds here. So where, I mean, I understand.
That's right. I'm not buying our bonds. And I'm not really buying foreign bonds either, because I think interest rates are going to rise worldwide. But it's a much bigger problem for Americans, because we have no savings, and we have to pay all those higher interest rates.
We've never had any savings, though. We've never had any savings.
Sure we have. Where have you been? You don't think we ever saved? How do you think we became such...
After World War II, our manufacturing base in this country was 44% of this country.
Yeah, how do you think we became...
Our economy was manufacturing. Now our manufacturing base is 13%.
Yeah. How do you think we became such a wealthy country?
You know what? What you're talking about is way in the future or way in the past.
No, I'm not. I'm talking about right now.
Not true. Not true at all. Not true at all.
Well,
not true at all. 2017, The budget goes bankrupt. The Social Security
Forget about
Trust Fund goes
2017.
bankrupt.
We're not going to make it to 2017.
Oh my God! I got to get my Kevlar umbrella out.
Peter, are you worried about those new ballistic missiles that China has that apparently can hit New York?
Look, we're not going to. China's not going to hurt us. We're hurting ourselves. We're the ones that have destroyed our own economy. We've gutted our manufacturing base. We've just been going on a consumption binge where we borrow money like drunken sailors from the rest of the world and blow it. And we pretend we have a viable economy.
But
because
Peter,
we measure our consumption.
where do you think, particularly the central banks, the foreign central banks, are actually going to stash all this money? Even someone like China, that's actively going out trying to diversify its portfolio, has such a huge trove of reserves that the dollar's always going to be, or dollar denominated, is always going to be a big piece of that.
It's not going to always be anything. Because eventually they're going to try to get rid of those dollars, and there's going to be no buyers. And sure, the Chinese and the Arab countries and the rest of the world, they're going to take a hit because the money they loaned us, we can't pay it back. But we're going to take a much bigger hit because now our economy is going to collapse because we're not going to have access to foreign consumer goods anymore and foreign savings. And we just don't have the resources.
You're talking about what's going to happen, what might happen, but there's no timetable for any of this. In the meantime, the market keeps climbing the wall of worry.
Well,
That's what strong markets do.
Yeah, I agree.
It's
in
not
terms, it is climbing
It's not
higher.
climbing if
I
you measure
hope-
it relative
Dow
to
My
Jones
portfolio is.
I hope that you will all stay around because it is time for another break. I'm getting a body bag brought out for you, Peter.
But why
I'm
do I
going to
need a
get
body
one
bag?
delivered to you. I'm getting one delivered.
Bring two. It could go either way.
We're making more money investing abroad
We
than
know that
anybody
we're
is
all going
investing
to end
here.
in a body bag. That's one thing we all know. All right, gentlemen, stick around. Michael Pinto, thank you, and our market panel going to be still with us. Up next. Joining us now, John Kudlow, Senior Vice President, Energy Analyst at Man Financial. He is a CNBC contributor, and he said he didn't hear some of the last words of the panel. He's stepping into the market panel, body bags and all. All right, so John, let's begin with you.
President Putin can certainly be protagonist in that discussion.
What kind of a Hobson's choice do we face here? Is it pretty much let him do whatever he wants, have whatever missiles he wants, build whatever he wants, so we can get oil?
He has got President Putin has such a bee in his bonnet, I can't believe it. And even today we're hanging on tender hooks because BP may be in the process of getting kicked out of their joint venture with TNK. Although there's a bit of a bright spot there because we were waiting for the announcement this morning. Didn't come because the Kremlin has postponed it until after the G7 meeting this week. But they claim there are some negotiations going on. So hopefully there's just some brinksmanship, but certainly this is just another complete turn for the absolute worst for consuming nations, and the United States in particular, because Russia for a while represented a separate column from OPEC in terms of being a major source of oil for the world.
And John, it was interesting, we had an FT columnist on today on Street Signs, and what he was saying is, hey, look, the silver lining here is Venezuela's worse, Middle East may be worse, at least in Russia, if they kick us out, we're going to know the terms. So at least the oil companies have a stable set of rules, as horrible as the rules may be. Is that a silver lining, or is that...
And, actually they are okay with that. I mean, especially ExxonMobil in particular has talked about that over the years. As long as they'll accept the political risk, as long as they know going into these things what's happening. But yeah, I mean, it just highlights to the American consumer, or should, that I say all the time, that the oil is really not in very undesirable parts of the world, at least vis-a-vis U.S. relations.
Yeah,
we just keep losing one after the other here. And as we go to $60, $70, $80 oil, it just gets the attention of the indigenous populations of these countries and makes the stakes all the more higher.
Is this going to get actually worse as time goes on, simply because with reserves sort of going down worldwide? What's going to happen is that more and more sort of unfriendly governments, or governments that want to be expansive, are going to sort of butt heads with us. I mean, is there anything we can do about that?
An interesting point to make. Teddy Roosevelt said, speak softly and carry a big stick. But it's very interesting. I mean, the United States has been speaking very loudly recently with China and with Russia, despite the fact that we've got no stick whatsoever. I mean, we are very dependent on the rest of the world. We need their resources, we need their consumer goods, and we need their savings. And it doesn't make any sense for the United States to be speaking like this when we're so dependent on
Hey, Peter,
the
they need us too. They need our
petrodollars.
spending.
The Russians certainly need our petrodollars. It's what's helped propel them to where they are.
They don't need us. They don't need us because we are just consuming. We're not producing. We're borrowing. They don't need our goods, and they don't need our dollars. That's why these foreign governments are accumulating so many.
Who else is going to buy all that oil?
We're still the #1 importer of crude oil in the world. Way
I know.
ahead of China
That means
still.
we're using up all the crude oil that would otherwise be consumed by other people people who would like to have it, but they can't because their governments are stealing their purchasing power and giving it to us.
Are you a communist, Peter?
No, I'm the biggest free market advocate of them all.
I don't know if I would agree. I think if the United States could shave our imports by even 10 or 15% in a rapid time frame, that would crush the price of oil, and that would put a lot of these governments out of business.
Now, ultimately,
and
what's going to
not look
happen
attractive at all to their people.
What's going to happen ultimately is the dollar's going to collapse, and oil prices will be several $100s a barrel for Americans, and we'll stop consuming, but the prices will fall for everybody else, and they'll consume a lot more.
Is there going to be any point in time when maybe we might want to consider perhaps drilling domestically?
We should be.
I mean, you know,
absolutely.
it's just such a political hot potato. That, to me, is where all of this ultimately is going to go. I don't know when. Maybe it'll be after the next presidential
John,
election.
how much do we have here? Let's just say that Governor Christ of Florida opened up offshore drilling off the coast of Florida, and we had Anwar.
Good.
We opened it all up. How much do we have?
No, we can't drill our way out of this problem at all. I mean, we can make some incremental gains, and there have been some great discoveries, even just recently by Chevron in the Gulf of Mexico.
Right. And plus,
it was a record drill in terms of ocean depth and Earth surface depth, but it's there. And also the straits between Florida and Cuba hold tremendous reserves as well.
Plus
as does the Gulf of Guinea off the west coast of Africa,
Right.
where we've been trying to curry favor. But you see how well things are going even in Nigeria over the past couple of weeks with their presidential election.
We can't get the oil out of the ground for free. It's going to require tremendous expenditure of resources, and it's going to have to shift resources away from other things. I mean, it's not, you don't just because you have the oil doesn't mean it's there.
Right, but
You start getting north of upwards of $100 a barrel, it almost makes sense to drill in Manhattan.
Right, but again, it costs money.
Not a bad
Come
idea.
on, Peter, you should be all for that. All right. We're gonna end it there. I had a wrap a little while ago, but since there was a little pause, I think I'll seize the moment. Gentlemen, thanks so much. We really do appreciate it, and please have a wonderful weekend. It's going to be
Thanks,
lovely
Aaron.
weather.
Thank you.
Peter,
Thank you,
even you, smile. Still to come. Keeping